Good evening, ladies and gentlemen. This is Samita here, and on behalf of Tata Steel, a very warm welcome to all of you to this call to discuss our results for first quarter of FY19. I must thank you all for dialing in. I know it's very late, and especially for those of you dialing in from Southeast Asia, very late. So let us get started. Our financial results have been uploaded on our website. There's also a detailed presentation which explains the performance in greater detail. I hope you've had a chance to go through it, but to walk you through our results as well as answer any questions you may have, we have with us today Mr. T.V. Narendran, CEO and MD Tata Steel, Mr. Koushik Chatterjee, ED and CFO Tata Steel, and of course several other members of the management team. Before I hand it over to Mr. Narendran, I would like to draw your attention to the Safe Harbor clause on page 2 of the presentation, which will cover the entire discussion today. Thank you once again, and over to you, Narendran.
Thanks, Amita. I'll start with a few broad-level comments and some more specific comments on Tata Steel, and then Koushik will take you through the financials. So the demand growth in China has been strong. It's been about 8% for the first half of the year. The production grew by about 6%. So hence exports is more or less under control. The production in the world, excluding China, was in line with expectations, and Chinese exports grew in the June 18 quarter, partly due to the higher production and aided by a weaker yuan. The exports in July have come down and are currently at an annualized level of about 69 million tons. The international steel prices did soften a bit amidst the ongoing trade frictions and the softness in raw material prices, but the spreads have remained resilient, reflecting the strong underlying demand. Increasing tariff actions, elevated oil prices, and weakening currency certainly are risks that we continue to watch out for. As far as India is concerned, the domestic prices remained buoyant, driven by accelerated economic activities, and despite what is a seasonally weaker period, India has done reasonably well. India has turned a net importer as the domestic prices have been strong, and that led to lower exports. So while the imports has been fairly stable because exports has dropped, we become a net importer. We believe the Indian steel markets will remain encouraging as steel-using sectors continue to demonstrate growth. As far as the European Union is concerned, steel demand is also strong, though UK continued to suffer a bit due to the uncertainty over Brexit. Southeast Asian steel demand remains sluggish with continued weakness in the construction sector. However, spreads have seen an improvement with the fall in scrap prices. As far as the performance of Tata Steel is concerned, Tata Steel delivered a strong performance across all geographies on the back of better realizations and buoyant spreads. Our Indian operation performed quite well, delivering a higher growth than the broader market. Key segments such as the automotive business, the branded products business, etc. continue to perform very strongly. The European operations also saw stronger profitability with an improvement in spreads as well as in the operational performance. The Southeast Asian operations delivered an improvement in EBITDA and maintained volumes despite weaker markets. We continue to progress on our strategy of expanding our footprint in India. Our Kalinganagar Phase 2 expansion is progressing well, with work starting on the cold rolling mill complex, which will help us in enriching the product mix and optimizing the cash flow. The other milestone in our growth plans has been the acquisition of Bhushan Steel during the quarter. I'm happy to say that the integration process is proceeding well, and all key stakeholders have been very supportive. We are confident that this asset will add significant value to our portfolio. On June 30th, we signed the binding agreements with ThyssenKrupp to form the 50-50 joint venture in Europe. We are now working to secure all relevant regulatory approvals, and we expect to complete the JV formation by the end of the year. With this, I hand over to Koushik to walk you through our financial performance.
Thank you, Naren, and good evening to all of you. I would like to share some highlights of our financial performance. Our financial performance was very strong this quarter across all our operations. Our group revenues witnessed a growth of about 22% year-on-year, primarily driven by improved deliveries and better realization across geographies. I would like to highlight that the underlying increase was higher at 28% if you adjust for the excise duty included in the first quarter of FY18, which was subsequently removed on July 1st, 2017. Our quarterly consolidated EBITDA registered a 33% year-on-year growth and increased to 6,559 crores with an EBITDA margin of 17.3%. The underlying performance of individual operating units was even better. Revenues of Tata Steel India increased by about 14% year-on-year. Again, here the underlying increase was much higher at about 26% compared to the first quarter of last year, which was inclusive of the excise duty. The EBITDA jumped in India by about 75% to 5,118 crores, which is a margin of 31.2%. The EBITDA per ton increased to 17,252 rupees. During the quarter, we also took an exceptional charge of 335 crores in standalone financials, primarily on account of provisions for interest in the case of the differential royalty on processed coal. Tata Steel Europe also performed well with an EBITDA of 183 million pounds, which is a Y-on-Y increase of about 21%. The EBITDA per ton was about 75 pounds or 6,800 rupees. The Southeast Asian business was steady with an EBITDA of about 110 crores. Following the acquisition of Bhushan, we have begun consolidating the numbers of Bhushan Steel with effect from May 18, 2018. So there is a stub period that we have consolidated. However, the consolidated EBITDA in our consolidated accounts is much lower than what the standalone Bhushan numbers have been for a multiple of reasons. Firstly, we are including the EBITDA for only half the quarter as the acquisition happened midway. Secondly, on acquisition, we have done a fair valuation of all assets. Accordingly, inventories have been valued at fair value as opposed to cost as done normally. And as the fair valued inventory has got consumed during the quarter, the cost has flown through the P&L. As a result, the EBITDA from Bhushan on consolidation is only 66 crores compared to the full quarter EBITDA declared by standalone Bhushan of about 823 crores. This is a one-time effect and will get normalized from quarter 2, and you will see the underlying performance getting consolidated. In addition, EBITDA includes some impact of unrealized non-cash adverse foreign exchange movement at some of our Southeast Asian financing entities. If you adjust for these two items, the consolidated underlying EBITDA from our operating entities would be much higher. Consolidated profit after tax for the quarter nearly doubled to 1934 crores on a year-on-year basis, which translates into a quarterly EPS of about 16.67 per share. The gross debt during the quarter increased by about 24,000 crores. The reason for the same is explained on the debt movement slide. Essentially, it is on account of the acquisition of the Bhushan Steel. There has been some increase on account of translation and working capital purposes. The liquidity position of the group remains strong with 24,984 crores, comprising of 13,000 crores in cash and cash equivalent and about 11,899 crores in undrawn bank lines. The capital expenditure for the quarter was around 1931 crores, which includes initial capex for the Kalinganagar Phase 2 and is in line with our overall guidance for the full year. I would also like to now give some commentary on the Bhushan Steel financials. We have had to redraw the balance sheet as on 31st March 2018 and then again on the date of the acquisition, which is May 18, 2018. In this process, the debt of about 25,185 crores on their balance sheet, which was part of the resolution process, was novated by the earlier lenders to our 100% subsidiary, Bamni Farm Steel, and that has been waived off. This has reduced their total debt to a sustainable level of about 36,058 crores. This includes the amount of funds Tata Steel has infused into the company. From a Tata Steel perspective and a consolidated balance sheet, the acquisition has had the following impact. Firstly, as indicated earlier, the gross debt has increased by about 16,500 crores on account of funding the acquisition, plus about 984 crores, primarily on account of the finance leases recognized to bring it in line with the Tata Steel accounting policies. Post the fair valuation of assets and acquisition, the net impact on our PPE is an increase of about 30,735 crores. As part of the acquisition and when we do the fair valuation, we have had a capital reserve by about 1,236 crores on consolidation. These are early days of the acquisition, and as we put in a stronger reporting processes, we will hopefully be able to give more disclosures with regard to Bhushan Steel as a subsidiary and bring them in line with Tata Steel. In the interim, I would request you to also go through the statutory financial disclosures of the company. With that, I'll end the I'll end the comments and open the floor for question and answers.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Pinakin Parekh from JP Morgan. Please go ahead.
Yeah, thank you very much, sir. Just 3 quick questions. So first, you mentioned that the Bhushan Steel EBITDA was on a reported basis around 800 crores, and the sales number is 0.85 million tons. So this implies the roughly 9,500 rupees EBITDA per ton. So going forward, should we use that as a starting base for the remainder of the year?
Yeah, it's about 9,800 rupees per ton. Well, if the steel prices stay where they are, I think that's a fair number to look at.
Sure. Secondly, the other segment has gone from a plus 4.5 billion rupees of EBITDA to a negative 4 billion rupees of EBITDA. So, sir, what was the quantum of the FX hit which came in the other segment related to those foreign currency loans?
It's almost about 1,100 crores.
1,100 crores, and that's the smaller subsidiaries were EBITDA positive in the quarter.
Yeah, all of them have been EBITDA positive. They have actually been PBT positive, but this is a non-cash translation change, so that's been recognized.
Okay. And lastly, sir, in the standalone results on slide 29, the other expenses says that it includes one-offs related to rates and taxes. So on the standalone operations, other than the reported exceptional items, so what would have been the one-off charges?
You're referring to which one?
Slide 29, standalone Q-on-Q variation.
See, the other expenses are mainly on account of some of the VAT facilities charges, which is about 134 crores, and there has been some disallowance of credit of accumulated education cess, and that's about 67 crores. Sorry, 32 crores. 32
and 134 crores, which were there in this quarter and which should not recur going forward. Correct.
And then there is a higher exchange loss, which happened on the revaluation of the same basis on the Tata Steel holding, which is roughly about 458 crores.
458 crores, which would be part of the other expenses.
That's correct.
Okay, understood, sir. Thank you very much.
Thank you. The next question is from the line of Rajesh Lachani from HSBC. Please go ahead.
Sir, my questions have been answered. Thanks.
Thank you. The next question is from the line of Saumil Mehta from BNP Paribas. Please go ahead. Saumil Mehta from BNP Paribas, please go ahead with your questions. As there is no response, we move to the next question from the line of Dhaval Doshi from Haitong Securities. Please go ahead.
Hello, sir. Congratulations on the good set of numbers. So first, a clarification, 458 crores of forex loss in the other expenses. This you talking of the standalone financials?
Yeah, that's correct.
And this is separate from the 1,100 odd crores, which is there in the other segment, right?
That's in the consolidated. Yeah, that's correct. So this is a holding. This is a holding directly into Tata Steel. This is in Tata Steel holding from Tata Steel, and that's the translation effect. When we are talking about the consolidated, it is at the Tata Steel global holding level in itself. So that's what come in the consolidated.
So the net forex loss would be to the tune of 1558 crores, or it will be restricted to 1,100 odd?
1,100. It's not. There will be elimination also.
Okay, there will be elimination as well. Okay. So secondly, with regards to Bhushan Steel, so there was a news article sometime back wherein Orissa government has given us the permission to use the iron ore from our Khonbon mine for the Bhushan Steel operations. So just wanted some clarity in terms of the timelines in terms of starting the transfer of iron ore, and what is the quantum of iron ore that we plan to work with.
So basically there are some approvals that we need to get. We've got some more are expected any time. So we have about 3 million tons of iron ore available in Tata Steel, which we can supply to Bhushan. And we have been, in the past, been allowed to supply to some of our subsidiaries where we are a majority holder. So we see no reason why that shouldn't be allowed for Bhushan Steel. But we are in discussion with the Odisha government for that, and hopefully in the next few days or weeks we should sort it out.
So 3 million tons in total, which can increase going ahead, or this is it that we're planning to do?
That is what is available for this year, but we are in the process of expanding our iron ore mining activity. Originally, it was to coincide with the expansion of Kalinganagar, but now that Bhushan Steel has happened, we are trying to see how quickly we can accelerate that.
Okay. And so lastly, on the inorganic acquisition, so my question does not pertain to Bhushan Power given the bids have gone today. Are we still evaluating other acquisitions apart from the Bhushan Twins, that one we've acquired and one we bid for? So there are news that one of the steel companies in Jharkhand is also calling for bids. So are we looking at or evaluating any of those assets?
So we constantly look at all opportunities that come our way. If we see value in it and if it has a strategic fit, we will certainly pursue it. So too early to comment just now, but yes, we are evaluating any option that comes our way.
Okay. Is there any targets in terms of debt that we are setting which we won't exceed in case of any further acquisitions?
See, we have set ourselves some long-term targets on debt which should be lower than 3x on net debt to EBITDA. But we are also a growing company because we are deploying capital in organic growth. So I would imagine that once we get into a bit more steady state, that's a better target to do. In the meanwhile, when we get into better cash flows, we'll certainly look at reducing our debt levels.
So this 3x net debt to EBITDA long term, so how long would that be? I'm sorry.
Post-KPO phase 2 implementation.
Okay. Thanks a lot, sir. I have more questions. I'll come back.
Thank you.
Thank you. Participants are requested to limit their questions to 2 per participant. Time permitting, you may come back in the queue for a follow-up. The next question is from the line of Rakesh Jhunjhunwala from Rare Enterprises. Please go ahead.
Yeah, good evening, sir, and congratulations on a fine performance.
Thank you.
Thank you.
If I understand correctly, your foreign exchange loss and your one-time charges, 1100 foreign exchange, 150 is the education cess, 700 crores is in Bhushan. So that was Bhushan's, write-off. And there is some depreciation also. You said there is higher one-time amortization charges for one mine. Hello?
Yeah, sorry, Rakesh bhai, can you just repeat the question because the line is very bad?
No, so you have 1100 crores of foreign exchange loss, non-cash.
Yes.
166 crores of education cess, which is not allowed, which you have provided for.
Correct.
700 crores of Bhushan you have to adjust because of the inventory and other things.
Correct.
1950 and depreciation also, you have said higher one-time amortization charges for mines. So how much is the higher one-time charge?
So all of that you said is mostly one-time, except for the fact that the foreign exchange moves both ways, as you know.
You may benefit also.
Yeah, that's what I'm saying. Last 3-4 quarters, there was a benefit. And
but Kaushik, can't you change your method of accounting so that this very non-cash charge doesn't fluctuate in your profits every year, every quarter?
I agree with you.
Because it's got nothing to do with operations. And it simply, gives volatility to your profits.
So, one outcome will be when we do deconsolidate Tata Steel Europe, there will be one such change. But so long as we have our debt in Singapore, we will possibly have to see these. As far as the other one-offs are concerned, these are mostly relating to cess and charges, which unfortunately is part of doing business in India because...
Now, Bhushan, you say production, they have got 1 million tons a quarter?
Yeah. We have, this quarter was 0.85.
So if you do 3.9 million and do 10,000 rupees, so you'll cover the interest cost, there will be no cash loss in the first year, and you'll cover part of the depreciation.
That's correct.
And as you get your, and 3 million tons of iron ore is enough for 5 million tons of production?
No. The other way around, typically 1.6 tons of iron ore for 1 ton of steel.
Right, so by what time you think you'll be able to ramp up the production to 5 million?
For Bhushan Steel, we are saying 2 years.
Right. And by what time, what about the value-added production in Bhushan? Doesn't that give you an higher EBITDA?
Yes. In fact, if you see I don't know if you've seen the NRs of Bhushan Steel are actually higher than the NRs of Tata Steel in India. So from that point of view, the realizations are higher, but the costs are also higher. Because, again, as you get the scale, you will get some benefits. As you drive some of the synergies, you will get some benefits. So the cost is higher, and hence the EBITDA margin, as we said, is about 9,800 rupees for the last quarter. And that is the one which we want to keep pushing upwards.
And eventually we have enough iron ore of our own in Odisha or in Bihar or Jharkhand where we can supply Kalyanagar expansion and even Bhushan?
Yeah, we have.
We have enough mines, we have to only work on them.
Correct. We have enough mines till 2030 and we need to invest. See, typically since these are captive mines and we can only use it for our own facilities, we had to align the capital expenditure to meet our needs because there was no point expanding the mines if we can't use the iron ore. So that's why we had planned it to match with the Kalinganagar expansion. But ever since Bhushan has come into our fold, we've been trying to accelerate so that we can expand faster.
Is it a very big capital expenditure to increase the mine production?
The Khonbon mine, which is the expansion which we are going through by 5 million tons expansion, we are spending about 2,200 crores.
And Mr. Renan, when you do this agreement with Thyssen, what is the amount of debt you will transfer to Thyssen?
20,000 crores.
2.5 billion euros.
How much?
2.5 billion euros, which is roughly about 20,000 crores.
And the debt, and you hope to get a dividend if you make a profit and along when you get your improvements, and you hope to service the debt in Singapore with dividends from there.
That's correct. That's correct.
Therefore, the effective debt of Tata Steel India will remain only of Tata Steel non-Europe will remain at 60,000 crores. That's what you're thinking and hoping.
Well, I think the question is when we do the deconsolidation, there's about 40,000 crores at the Singapore level, which has to be...
Debt will be removed.
Yeah. No, it will be there. It has to be serviced from the dividend and earnings of the JV. And if there are any further monetization opportunities, then it will be principally removed from that.
Are you going to consolidate or are you going to treat it as an investment?
No, so the JV is deconsolidated, treated as an investment, but the Singapore debt is 40,000 crores will be consolidated because that's part of Tata Steel. We are 100% owners.
So you have 40,000 crores. So today you have 20,000 crores debt in Europe, 40,000 in Singapore, and 43,000 in India.
That's correct.
56,000 in India, 13,000 cash. Am I right?
That's correct. Roughly, yes.
Thank you, sir. Congrats on a fine result.
Thank you.
Thank you.
Good luck.
Thanks.
Thank you. The next question is from the line of Anuj Singla from Bank of America. Please go ahead.
Yeah, thank you, sir, for the opportunity. So first question, on slide 24, there is a working capital build-up around 2,926 crores. Is this pertaining to the inventory build-up at the standalone operations or some portion is contributed to the Bhushan Steel working capital as well?
Yeah, both.
Is it possible to quantify how much will be Bhushan Steel and...
Yeah, so its standalone is about 1,500 to 1,600 crores and the balance would be at Bhushan and Europe.
Okay. And so one clarification on the one-offs which you mentioned. So firstly, you mentioned there is a VAT charge of 134 crores. What does that pertain to?
VAT charge?
So I think I did not get it clearly. There was a 134 crore one-off in other expenses which you mentioned.
So no, as far as we have said that there is a Tata Steel holding in Singapore.
So for the standalone entity I'm talking about, standalone entity. So there was an exchange loss of 458 crores. Is that fine?
Yeah.
then there was a non-allowance of accumulated credit for educational cess.
That's correct. That's correct.
What was the quantum of that, sir?
So there was a VAT charge also, VAT charges, right?
VAT, okay. So, yeah, understood.
VAT, rates and taxes was about 125 crores.
Okay.
And there was the VAT charges was about 67 crores. And there was a disallowance of on the accumulated education cess on the GST of about 32 crores.
132?
32
only. Okay. Yeah. Understood. And, sir, one clarification again. You said that 25,000 crores of loan for Bhushan Steel were novated to Bamnipal, and that has been waived off. So
yes,
has this been written off, so Bhushan Steel doesn't need to pay any interest for that?
That's correct. It was written off and it was routed through equity.
Okay, so if I remember correctly, sir, so because if I understand, our economic interest of 100% was premised on that only, that they will need to service the interest on the debt which has been novated to us. Is my understanding correct, or so all the cash flows will come to Tata Steel rather than going to the rest of the shareholders?
So Tata Steel also has contributed about 18,000 crores as far as the contribution is concerned, and many of that, or all of it at this point of time, is intercompany loans. So there is a serviceability there, and as we are going to do the takeout financing for this, we will structure it so that we get the economic interest captured.
Okay. Understood. Thank you very much.
Thank you.
Thank you. The next question is from the line of Amit Dixit from Edelweiss. Please go ahead.
Thanks for the opportunity and congratulations for a good set of numbers. Sir, my question pertains to Bhushan Steel. If we look at the financials and the production numbers of Bhushan Steel in Q1 FY18, the production was 0.97 million tons, implying capacity utilization of 69%. That actually went down in Q1 FY19 to 65%. So was it due to the fact that we there was a phase of a startup in Bhushan Steel that we had? And what would be the steady state capacity utilization, the exit rate capacity utilization in FY19?
So the production was around 0.91. I think the sales was about 0.85 in Q1. Okay, and the reason why the sales were slightly lower is we were making some changes in the practices on credit terms and making some adjustments for that. So the market took a while to adjust to those changes. But basically, the production rate is 0.9. And if you do 0.9, you'll be better off than last year for the full year.
Okay, fair enough. The second question is with respect to export sales. In this quarter, our export sales were down actually. Was it done because the domestic market was lucrative, or because, because of this tariff and all, we didn't find those many markets to export?
So we reduced exports because the domestic markets were strong. Typically, the prices in the domestic markets are about 2,000 to 3,000 rupees higher than the export markets. So we can sell more in the domestic. We would prefer to sell more in the domestic.
Great, sir. Thanks. I have a few other questions, but I'll get back in the queue. And all the best.
Thanks.
Thank you. The next question is from the line of Abhishek Poddar from Kotak Securities. Please go ahead.
Hi, sir. Thanks for taking my question. Sir, in the European profitability, you have shown a bridge of 27 million pounds related to manufacturing. So what is that pertaining to, and whether that is sustainable?
It's a lower cost that you've seen, right?
Yeah, there's a positive contribution of 27 million pounds from manufacturing that you have shown in the EBITDA bridge for Europe.
That includes spend management and lower spends on overheads, lower spends on other expenses, which includes other than one repair maintenance cost, most of the spend trends have been lower.
So should we assume that this is something which is ingrained and will continue to accrue?
That is part of you have to look at not by element-wise, but you have to look at both by spread and the numbers. So if this is the numbers that we've got, and normally the first quarter is where we do not have too much of spends on account of repair maintenance, because quarter 2 and quarter 3 is where there are shutdowns mostly taken. So that's how the trend works across 4 quarters.
Okay. Fair point. Sir, second question is regarding the CAPEX. I think at the start of the year you had mentioned a total amount of about 9,000 crores for this year. After Bhushan, do you want to revise that number or it remains the same?
Not materially. Because Bhushan Steel does not have any substantive structural CAPEX to do. It's the sustenance improvement CAPEX which a normal steel company does.
Sure, sir. So within that 9,000 crores, KPO, Jamshedpur maintenance and KPO maintenance as well as Bhushan maintenance would be part of it?
Not maintenance, it's sustenance CAPEX. So I think Bhushan will be in the region of say 600-700 crores.
So this 9,000 crores includes the tail end of Kalinganagar Phase 1, includes the beginning of Kalinganagar Phase 2, includes raw materials, and includes regular maintenance expenditure, sustenance expenditure, CAPEX.
Okay. Thanks a lot, sir. Thank you.
Thank you. The next question is from the line of Sanjay Jain from Motilal Oswal. Please go ahead.
Hi, thanks. First of all, congratulations on good numbers. And my question is actually more strategic. Like when we look at Tata Steel, I mean, as in one of the questions asked earlier, you said that, you know, Bhushan Power is not end of our acquisition spree, and you will continue to evaluate all the opportunities that come our way. My biggest challenge with Tata Steel evaluation has been that there is no end of this inorganic growth, and there is no, end of we raising equity from the market. Like, so both this revenue and the equity base, both of them are like, floating. And what has happened in all our group, the steel sector has one inherent issue. Whenever there is a greenfield project, initially the project costs are so high that it actually erodes equity value because market never values on replacement cost basis. And that's one of the reasons, like if I trace back our history for 12 years, shareholders have not been able to make significant return despite the fact that we have the most profitable business. Can you, say that, look, I am not going to raise more equity here from here, and this is all end to it, and we will try to create some shareholder value from here on.
So, Sanjay, since you are an ex-steel guy, I think you would understand the business in the context of the CAPEX and growth. First is, I think our growth broadly is in line with the market growth. So it's not catapulting us ahead of our time. If every year the market is growing at about 5% or 6% at about 5-6 million tons, all our CAPEX is targeted towards to be in line with that. As far as, and if you look at the Kalinganagar Phase 1, which we completed, has a lot of enabling CAPEX of Phase 2. So therefore, the CAPEX intensity, and we've talked about in the past, up to HR stage has been very significantly lower than any benchmark. So we, I think, know that in the steel business, as far as India is concerned, you have to grow. I think the IBC opportunity was a one-off opportunity. It's not something that happens on a planned basis. And some of the assets that came up were of interest. I think we've got one of the best assets in this process. It's already showing results, and we are, as you would see as we go along the next few quarters, that the value of that asset will be reflected. And secondly, the organic growth platform is also competitive, as I talked about the 5 million ton expansion in Phase 2. So these two are the biggest. So we're talking about 10 million tons of very competitive capacity on the existing 13. Third, we are looking at very strategically we have now gone and signed the definitive agreement as far as Europe is concerned. So that will be deconsolidated. The pressure on Tata Steel's cash flow to support the European portfolio will not be there. On the contrary, because of the strength of the two businesses, we are talking about, even on a last 12-month basis, a pro forma EBITDA of about 1.7 billion euros Add to that the identified cost synergies. We're not talking about any other synergies. It takes us beyond 2 billion euros on a steady state basis with a capex of about 800-900 million euros. We have a free cash flow positive business, which is not levered to the extent of any financial stress, because we're only talking about an external loan of about 2.5 billion euros plus the working capital lines. So we are talking about a robust Indian portfolio that has the ability to, first time in the last decade, service the shareholder, in this case the shareholder being Tata Steel. And therefore, I think we have structurally resolved one of the pain points as far as the Tata Steel's portfolio is concerned, which needs to be recognized because we are talking now into a very different platform. The consequence of the growth, the consequence of the strategic issues would certainly help Tata Steel bottom line, cash flows, and competitiveness to play a long-haul game and grow. And we can't say that we will not grow. We need to grow in a manner where our capital allocation process is disciplined. And I think that's what you would see going forward. And we should look at growth which creates incremental EPS and incremental shareholder value.
So if I can add to what Kaushik said, see, 10 years back, you said 10, 12 years. 10, 12 years back, we were 25 million tons, out of which 18 million was in Europe, 4 million was in India, and 2 million was in Southeast Asia. Right? And in the last 10, 12 years, the shift which Kaushik described is today brought us to similar volume, but the mix has changed entirely. So you have about 13 million in India, excluding Bhushan, and 10 million in Europe, and another 2 million in Southeast Asia. And even within Europe, out of 18 million, 10 million was in the UK and 8 million was in Netherlands, and that mix has changed to 7-8 million in Netherlands and 3 million in UK. So if you see the overall mix of the assets, it has changed. And even in India, as we, in some sense, spend more capital to acquire more assets, even today, if you see the Bhushan numbers, in the very first quarter, even without us being there for most of the time, the EBITDA is closer to 10,000 rupees a ton, which is, much better than the European EBITDA because of structural reasons. I mean, this is a growing market. The best quarter in Europe has got us a 6,000 to 7,000 rupees per ton EBITDA. So there is a structural change in our footprint. And as Kaushik said, in India, it's a growing market, so and it's a fairly strong EBITDA market. And we believe that with this structural shift, the cash flows should help us deleverage. In fact, we would have deleveraged significantly if not for these IBC assets, but that's an opportunity which obviously doesn't come very often, and we had to obviously move in that context.
Yeah, I understand all of, you have said all of these points in past, but only my concern is that even now in all these discussions, you're not putting a lid that we won't raise any more equity in future. We continue to raise equity on any drop of the head, any opportunity comes. And even if I take Bhushan Steel, your assessment of EBITDA per ton, and even if Bhushan Steel produces 5 million ton, I'm not sure it's going to produce 5 million ton unless we do additional capex. And then also like 5,000 crore EBITDA, and what we paid is more than 7 times, right? Market never values these assets at these multiples. And that leads to market cap erosion. So we need to, in our strategy, also, take into consideration, that market cap kind of how the market is going to, look at it. Because, see, if the shareholders don't make money over a longer period, just because, see, our focus is on growing top line. Most of the time I'm seeing, but there is less focus on, bottom line. Unless we change that strategy, shareholders are not going to make money.
So, Sanjay, I think the first is that you talked about the equity. Let's address that. The last time we raised equity was 2010 on an FPO. This is 2018, so 8 years in the journey. And this had a clear growth identified for which this equity had gone, which I believe will be EPS accretive. Secondly, I think it would be unfair to say that we've been focused on top line and not bottom line, because if you're not focused on bottom line, India would not have generated 31% walking in the garden. So I think there is a lot of effort by all our operating colleagues to ensure that we generate the right bottom line. We have had a situation which is a embedded situation as far as our debt is concerned because of a European portfolio. The option before us was to continue the status quo or to take structural calls in terms of making it ready for a strategic end state, which will be robust from our perspective. We looked at various options, including getting out of the portfolio. We felt that a consolidation as far as Europe is concerned will be worthwhile, for which we resolved fairly strategic issues as far as pensions is concerned, long products is concerned. So all the underperforming assets have been gradually and step by step we've been removed. We remain with Himawdan, which is the most profitable asset, and we have consolidated the UK asset base to one unit in Port Talbot, which is very small, which is like 3 out of 21 million tons. So the risk profile has changed completely. And we have Duisburg on TK side, which is also a very strong asset. So as I said, that if you look at it from a strategic solution perspective, I don't know if there could have been a better solution to what we have gone into. Secondly, as Naren mentioned, and I mentioned in the beginning, that in India, it's a growing market, and a growing market not for volumes, but a growing market for value. So we have, as I said, that our bottom line wouldn't reflect what it is if we had not have the ability to extract value out of our operations. So there is, steel is a long-haul game. Steel, there are many companies which have gone bankrupt in playing this in the steel cycle. We, I think, have the strong resilience of the organization, people, processes, and finances to come out of it. We, I think, are structurally a lot more stronger than we were 8-10 years back. I think the life ahead always will have challenges, but I think we have structurally important capacity build-up, because shareholders will also not get value if we do nothing. And as Naren mentioned, the mix of capacity changed very significantly. We could have the ability of putting all our internal generation in deleveraging and losing market share by remaining 4 million tons. Would the shareholder be happy about it? They would have said, you've not grown, you've delevered only. So we have always calibrated our growth, financial risk, deleveraging, balance sheet in a manner that suits the best path forward. And we have faced years like the 2008 crisis, we have faced years like 2014, 15, 16, and we have come out of it only stronger with more competitive assets, better position in the market, better differentiated products, better cost position. And therefore, that's reflective. As I said, that it's just not the price which has today given us 31% or thereabouts. It is a lot more than price. Otherwise, everybody would have got that. So I think and there are good peers also for us to follow, and we continue to benchmark ourselves and give that value. So I think that steel is clearly focusing capital on the long term, and the shareholder will get benefited. We had an embedded situation in Europe, which we have come out of or coming out of, and I am sure that the growth trajectory and the leverage that we have as far as our India franchise is concerned will certainly pay a dividend to the shareholders in the future. And I think that's the belief system that we in the management team and the board have. I'm sure the shareholder is the same.
Yeah, okay. I mean, we'll end this discussion here. Thanks.
Thank you. Participants are requested to limit their questions to 2 per participant. Time permitting, you may come back in the queue for a follow-up. The next question is from the line of Mir Muntasir from Emirates NBD Asset Management. Please go ahead.
Hello. Hi. Congrats on the numbers.
Thank you.
Yeah, I just had very few small questions. One is, I wanted to know, in Q2 last year, we had a very small cash balance, the cash and cash equivalents, which we saw at the end of the year go up by quite a bit. What is the Q1 cash balance like?
13,000. So we have about 13,000 crores of cash and about 11,000 crores of lines. So our total liquidity is about 24,000 crores.
Perfect. Just sorry for my ignorance if I've missed, if you guys have mentioned this earlier. Just wanted to, just a little explanation on any, could you please tell me what are the effects that you're actually seeing on the ground now with the devaluation, the effects of that's coming up due to the devaluation?
Yeah. So for Tata Steel, particularly the Indian business, weaker rupee is positive because while on one hand it increases the cost of imported coal, but overall, since the Indian steel prices are linked to the international prices, a weaker rupee brings more stability to the domestic prices. So overall, it's net positive for Tata Steel and the rupee weakens.
Right. What does it feel like in like 8 months? We're going to have most probably some news out of the Brexit. So any possibility? What are you seeing? What could happen on that side of things?
Well, Brexit so far, from what we've seen, is going to be more of a soft Brexit than a hard Brexit. And I think, so if that is so, then there should be less disruption. Of course, a lot depends also on where the pound behaves, because that will have an impact both on our costs in UK as well as in the competitiveness of our exports from the UK.
That should be good. Thanks a lot.
Thank you. The next question is from the line of Abhijit Mitra from ICICI Securities. Please go ahead.
Yeah, thanks for taking my question. First question relates to Tata Steel Europe, the manufacturing gains which have been shown in the bridge. The comments have been made that it relates to increasing efficiencies in strip products UK. So I remember you mentioning that there was some one-off in Q4. Is it, strip products coming back to full operational form in this quarter and thereby contributing to this gain? Is it a fair understanding of the issue?
Yeah, so we did have a bad Q4 because we had a number of problems in the blast furnace as well as in the hot strip mill in the UK. The UK has had better performance compared to Q4. The steel plant has had a better performance, but still there is work to do. So in this quarter, there is going to be a shutdown of the blast furnace for some time. So Q2, there will be less production in UK. But Q1 was better than Q4 because of better operational performance. And hopefully, because the shutdown is spanning Q2 and Q3, part of Q2 and part of Q3, when we come back after the shutdown, hopefully we'll be well positioned for a good Q4.
Okay. And the second question is relating to this inorganic acquisitions, which I think one of the previous participants also mentioned. I think, point number one is, are we looking at some market share within the country when we have, this, acquisitions in our mind? And secondly, are the bids that we are putting in factoring in the possibility of, change in cyclical pattern? Because spreads are very high. You hardly remember 17,000 rupees per ton being done by Tata domestic over the past so many years. So given that it's the peak spreads that we are seeing over such a long period, is some contingency factor being built into the bids that are being put in while we are showing our interest and inclination for these assets? I think that's, if you can throw some light on that, it would be great. Because, at probably without operational synergies factoring in, Bhushan is doing 10,000 rupees per ton with a certain amount of help from the market. What do you feel that once you have walked your way around the asset, what can be the mid-cycle EBITDA like? And similarly for other inorganic assets also which you are looking, what kind of thoughts you are putting in terms of a through-cycle EBITDA per ton and, through-cycle multiple that you probably will be looking for this asset. So that, if the cycle turns south, we are not left with inordinately high net debt per EBITDA.
Yeah. So a few comments and then Kaushik will supplement what I say. So firstly, if you asked about the market share, right? So overall, even if we were to retain our market share in India, at the current growth rate, we need to add 1 million tons a year. Okay, this is just to stand on the spot. Because the Indian market is about 100 million tons and growing at 5-6%. In fact, so far this last few months it's grown at 8%, right? So to me, if we are to keep our market share, a minimum of 1 million tons a year is what we need to add. And Bhushan has basically brought us that because the next Kalinganagar expansion is going to take 3 to 4 years, right? So to me, at least retaining our market share is a minimum that we will aim for. And increasing market share is something we will certainly look at. But when we look at market share, we are not looking at the overall market share, but we are looking at the market share in the high-end segments. So in a segment like automotive, which is very profitable and good, we have a 40-45% market share, and we certainly hope to retain that. Now, if the auto industry is growing at 20%, which it has done this year, then unless we grow in that segment at that rate, you will again lose market share to others. So we look at market share at a more elemental level at product segments in the B2C business, in the automotive business, and other high-end businesses. And we have a fairly strong downstream franchise also with some of our subsidiaries and business units like the tubes business, the wires business, tin plate business, so on and so forth. So that's the overall comment on the market share. The second point is on the spreads. So you said about 17,000 rupees. Yes, it's been after a long time, but it has not been the highest EBITDA that Tata Steel has done in the past. 31% again is a high EBITDA margin, but again not the highest that Tata Steel has done in the past. There was a point in time when Tata Steel was in the 35 to 40% quite regularly. So to me, it's a good EBITDA, but if you look, at our past, it's not an unusual EBITDA. The third point I want to make is $600 price for hot rolled coils is not an unusual price. In fact, it is pretty much the average if you look at the hot rolled coil price for the last 10 years or 15 years. If you compare with 2015, it looks very high. The prices in India look high because of the fact that the rupee has moved from 50 to 70 or 69 in the last 2-3 years. So that's why the prices in rupees look much higher than it has been in the past. So the spreads are slightly on the higher side, but I don't think it is very abnormal. There are some structural changes happening in the industry as well, mainly led by China. I think while we had tremendous demand growth in China in the last 10-15 years, we've also had to deal with the situation where China has been exporting a lot, and many Chinese companies were happy to export even though they were losing money. But things have changed in China in the last 2-3 years. While the demand has not been as bad as we had thought, more importantly on the supply side, there's a lot more tightness. And the Chinese industry is also consolidating around the bigger guys. We have never had much of a problem competing with a Hebei Steel or a Bao Steel because they are as disciplined as we are or any other big player is. So I think there are some structural changes in the industry which will lead to a bit more discipline in this industry. Over the last 10-15 years, ownership in this industry had shifted from private sector to public sector because of the growth of China. And that is getting a bit more, readjusted, if I may say so. So there are some structural changes which makes me believe that a $550 to $650 hot rolled coil range of prices is not an abnormal expectation. And if you look at it on the other flip side, the iron ore prices have been fairly stable and is in the $60 to $80 range. And it's the coking coal prices which move up and down because the liquidity in the market is very low. But at $60 to $80 iron ore price and maybe $170 coking coal price and a $600 hot rolled coil price, I don't think we have a very unusual situation. As far as the leverage and the market in India is concerned, obviously when we look at long-term prices of hot rolled coils, we actually assume in our own numbers less than what I've just said, just from a conservatism point of view. And Bhushan doing 10,000 rupees, frankly, Bhushan should be benchmarked with the other players like JSW and JSPL, and we should be aiming to get similar EBITDA levels as them. So I don't think at 10,000 rupees it is the highest level that Bhushan can operate at. As we expand capacity there, as we bring in more efficiencies and the synergy benefits, we certainly would look for a higher EBITDA per ton there, and a good benchmark for Bhushan Steel would be the other standalone steel producers that we will look at.
Yeah, just to add, Abhijit, on this is, one is the fact that when we look at some of these, there are two parts, as Naren rightly mentioned, that it is based on long-term spreads other than current spreads or current prices. And therefore, our valuation expectations are on that basis. Secondly, it's important that we also look at proximate synergies that we can drive, and that is important for us, and that's why you would see that we have had a particular regional preference, because that's near about our rest of our asset base. Third is, I think these are acquisitions and not new volume into the market. So therefore, while there is a debottlenecking volume, essentially it's not creating that lumpiness in the market, so it comes at existing volumes. Fourth, I think, is from a valuation point of view, we have had an experience of building a steel plant in Kalinganagar over almost 10 years. And building another greenfield steel plant is pretty challenging, not impossible, but challenging, and there is time dependent. So obviously it would, when we look at any acquisition, we also look at replacement cost, and that is important in the context of time, because there is a time value of money, and so that's the basis on which we have bid and acquired Bhushan Steel. That's not necessarily the same for all the other targets, and neither are we saying that we are chasing every target that is available. We have been certainly be selective, and we'll look at ones that helps us both in the market, operationally and financially. So I think it is not that we will play for any target that is there. You would have seen that one of the big targets for which we did not bid. So it all depends on how you see the value to us, including raw material leverage and so on. So that's the basis on which we have taken the call.
Great. So this clarity helps. Thanks a lot. That's all from my side.
Thank you. The next question is from the line of Bhaskar Basu from Jefferies. Please go ahead.
Yeah, thanks. Good evening. Just a couple of questions. Firstly, just on this one-off, I just want to understand. To be clear, you mentioned about 225 crores on account of VAT, cess and all, and additional 458 on account of Forex at the standalone level?
Yeah, that's correct. So it was one-off again I repeat, one-off in terms of rates and taxes, 125 crores. VAT was about 67 crores, visa allowance on education cess about 32 crores, and taxes on C-Form about 26 crores. So, and the exchange loss on account of revaluation of our direct holding on standalone was about 126 crores.
126 crores?
Yeah.
Okay. Because I thought it was 458 crores, so my bad.
So in the last quarter of FY18, it was a gain of 332 crores, so the change is 458 crores.
Okay. Which was basically where I was coming from. In the bridge, you have about 400 crores of one-off mentioned.
That's correct.
So that's where, right, okay. Secondly, just a housekeeping question in terms of coking coal costs. Where are they for the current quarter, next quarter versus the current quarter?
So it'll be pretty flat. You are talking of Q2 versus Q1?
That's right.
Yeah, it'll be pretty flat.
And where are realizations versus the last quarter?
Well, we are forecasting about 500 rupees lower than last quarter. Slightly lower.
Okay. That's all from my side. Thank you.
Thank you. The next question is from the line of Rakesh Jhunjhunwala from Rare Enterprises. Please go ahead.
Hello. Hi. The question from the other analyst who says that Tata Steel is not given return. The fact is the disaster was Tata Europe. That's no longer incurring. Tata India is a money machine. Right? And that Tata pain is now coming to an end.
That's what we believe.
So whatever value it has, I personally feel that the pain is coming to an end and the money machine is now, running faster and faster.
Thank you, Raghaji.
That's my point of view. I don't know. I can always be right and wrong. But you have to admit that Tata Europe was a disaster. And that's the price that we have paid for 8 years. But fortunately, that's coming to an end, and India, the machine is just running faster and faster. That's what I wanted to say. But, you will hesitate in saying it, I'll say it. Yeah.
Thank you.
Thank you. The next question is from the line of Ritesh Shah from Investec Capital. Please go ahead.
Yeah, hi, sir. Thanks for the opportunity. So my first question is, there were news flow on Southeast Asia business. Basically, it was on the block. Is there any truth to it?
So nothing is true, nothing is false. So because I think we look at our portfolio at intervals, and I think, to be fair, Southeast Asia itself has already restructured a lot in terms of Nat Steel, which is divested of Hong Kong, it's divested of Australia, Malaysia, Philippines, so I think China, and a lot of restructuring has already happened. But these are times when everybody has a performance target to achieve and alignment to the long-term strategy of the company. So we keep an open mind as to whether there are ways in which we can restructure further or look at alternative options also if there is one. So at this point, there is nothing on the table, but I just can't say that any restructuring is ruled out.
That helps. So second question is, in the recent Tyson presentation, it indicated that because of the JV, pension-related payouts would reduce by more than 200 million euros. I think to my understanding in the earlier calls, we had indicated for $200 million. Please correct me if I'm wrong over here.
No, so it is 200 million euros is their cash outgo every year at this point of time. Part of it is in the EBITDA, part of it is in the interest charges, and aggregate number is 200 million euros at this point of time. So when they carve out that 4 billion, roughly 3.8 billion euros, that is the impact that they have said as the advantage to them.
Okay. Specific to the JV, there were accumulated losses at Tata Steel Europe. I think in the earlier calls also we haven't made any comments on deferred tax assets or probably lower tax rates. Any visibility over here? I'm more looking at it from a cash flow perspective, how the dividends will play out.
Too early at this point of time. Actually, the closing balance sheet issues are being worked out. It's a fairly complicated one. We need a little bit more time. After which we can do it. Only principally I can say is that the bulk of the tax losses reside in the UK. There are some tax losses in Netherlands also, and that will be used because this is resident in Netherlands as far as the JV company is concerned. Therefore, we would be able to hopefully form a tax unity in Netherlands, and then it will be subject to the tax regimes as far as for dividend payout is concerned. The Netherlands also has fairly friendly dividend payout policies or laws because it wants to attract headquarters of multinational companies. So that will certainly play out in these number of ways. However, the overall situation can get more clearer because there will be no tax union in Germany. There will not be any tax union in the UK to offset because those will be fundamentally be standalone on its own. The tax union will only be in Netherlands, and that's where it will leverage upon the carried forward tax losses of Tata Steel Netherlands, which is there. So at least in the initial few years, that will be put for application for tax purposes.
This helps. Just last question, sir. I think there have been concerns on the valuations on the assets that we have looked at. Sir, it would be good if you could highlight the growth optionality for these assets and along with the timeline, say, Bhushan, if you are expanding, say, will it be next 3 years, 5 years, to what capacity, or say Bhushan Power whenever it comes under our lap. If you could highlight something specific to Bhushan Steel, it would be of quite use.
Yeah. So Bhushan Steel is currently at 3 million ton level. I mean, last year was about 3 million tons. This year we will be around 3.5, 3.6 million. And we are heading towards 4. Basically, we are trying to see how can we get as fast as possible to 4 million tons. Within 24 months, we want to take it to 5 million tons. That's the timeline. Okay, and it doesn't need any significant capex to go to that level. It's more sustenance and debottlenecking capex, because most of the assets are in good shape, and that's why we bid for it. And the full capacity is about 5.5 million tons. Okay, and our focus is to get it to that level and then stabilize things, because by the time we get this to 5.5, the Kalinganagar phase 2 would start. So that gives us another 5 million tons. So once we have this 5.5 from Bhushan and the additional 5 from Kalinganagar, we can think about it depending on the demand and our balance sheet and many other things. Yeah.
This helps. Thank you. Thanks a lot.
Thank you. The next question is from the line of Vineet Malu from Birla Sun Life Asset Management. Please go ahead.
Hi, good evening. My question is again related to acquisition only. I mean, it will be great if you could highlight, what is the constraining factor for you when you're looking at an acquisition. I mean, you've shown the ability to live with a hump in net debt to EBITDA ratio, etc., right? So I just want to understand, even if you find a good asset, what is the constraining factor which acts as a discipline on the balance sheet?
So I think it would be important to understand that, as I mentioned in one of the answers previously, it is certainly to look at the balance sheet, the overall absolute level of leverage, the level of earnings potential, and I think when we look at earnings potential, I think people sometimes mistake that we are only looking at it because there is a peak in the cycle or prices are better just now. It is more from a longer term perspective. Second is the ability to, as Naren just mentioned a little while back, to grow along with the market. If it is an organic basis, then what is it that we can do? From an acquisition perspective, what is the replacement cost equivalent? So from a constraining factor, obviously the balance sheet is a constraining factor, but we have lived through the cycle and we have crossed levels as far as leverage is concerned, only because we have been confident about the underlying assets. So as far as the ability of, first is ability to service all our obligations, whether it's financial obligations in particular. Second is we have understood clearly that the balance sheet would be a constraining factor. We don't want to go much beyond currently the level of debt that we are in. Unless there is a compelling reason, like IBC was not in the plan till it actually came onto the table. Now, if we had not looked at the good assets, then we would have certainly gone into a zone where we would have curbed our ability to continue with the market share and our ability to service the customers, and also on an underlying basis not have the profits and cash flows in growing to service our financial obligations. So I think the balance sheet is certainly a constraining factor. Also, the market growth is a constraining factor. The very fact that we are not looking anywhere outside India, the very fact that we are looking at regional strength, which gives us proximate synergy, gives you a sense that we are not going to, and even in this IBC process, we have not bid for all assets. We have only bid for assets which make sense for us.
Sure. So I'm just to be clear, I'm not questioning, why we're going for Bhushan, the two Bhushan, etc. I'm saying now that, assuming we have two Bhushans in our kitty, right, now that we are actually going ahead with Kalinganagar phase 2 expansions, right, so we've got quite a bit of growth, within Tata Steel for ourselves. I'm saying beyond this, what is the constraining factor is what I'm trying to understand, so that you will not look at other assets. Because I understand leverage, as you said, you would look slightly longer term and you're willing to live, with a hump in those ratios, etc. So, beyond this, what is it that, you said, this is it, and, let's just first, execute on this growth plan, and then after a certain point in time, you will look at it.
So I think the balance sheet itself, because I don't think we will have anything on a mega scale for growth after what we are doing just now. And by the way, BPSL is not with us. It's in the most confused state of play at this point of time. So we are talking just now about Bhushan Steel and Kalinganagar. If there are opportunities, I think those opportunities will be much smaller in size, both in volume as well as in the value. But we will be very, very careful whether it brings us it gives us enough value to go for it. At this point, we don't have much. We'll also look at our existing portfolio and look at unlocking value and monetizing some of them so that we can live within the means of the balance sheet and ensure that we do not have anything which is very significantly beyond what is crafted to be as the next 5-year strategy for Tata Steel.
Sure, sir. Thanks so much. I mean, if only, I may suggest that if you could have sort of a high watermark for raising equity, whatever price you raised it last year, you have to raise it at least, certain percentage higher than that. And that should also help us, towards creating shareholder value.
So we hear conflicting feedbacks, but I think that's right, and I think we need to ensure that we balance, as I mentioned earlier also, that our last FPO was about 2010, after which we went into the rights, which was overwhelmingly supported by the shareholders. I think we have put good use to that capital, which will pay back very well. And at this point of time, the large chunk of investment is in KPO, and we'll see what the outcome of this BPSL is. But other than that, there are no large capital outlay programs. In fact, we will sweat the assets that we have between Bhushan Steel and Tata Steel existing for the next few years. And any opportunities that come on the inorganic side will be much smaller, if at all.
Sure, sir. Thank you very much and all the best.
Thank you. The next question is from the line of Ashish Kejriwal from IDFC Securities. Please go ahead.
Yeah, thank you. Sir, my question is about this other expenses only, where you mentioned that 126 crore of loss was there in this quarter. So, because of rupee depreciation, we get benefit in our P&L, that is in top line. But this kind of expenses, is it only M2M only, or will it be realized soon, if assuming that rupee is going to depreciate further?
No, so MTM, I don't have a view, because I think it depends on how the currency movements happen between. We have a balance sheet outside which has an interplay between pounds, euros, and dollars. So this is so as I said, last time we had a 332 crore MTM gain. This time there is a 126 MTM loss. So that keeps happening. But as far as the one-off on the rent, rates, taxes, and provisions, etc., these don't happen very often, other than the fact that if there are any revisions on retrospective effect, they may come in. But otherwise, never planned for.
So, sir, what is this amount pertaining to? Means on what revaluation of assets we are ascribing to this gain or loss of forex in standalone as well as in console? When we are seeing 1100 crore forex loss, is it possible to quantify the amount on which movement in dollar or pound that keeps on changing?
Yeah, maybe we can do it offline.
Okay.
But I can give you some numbers. I think we have this Tata Steel holding, which is the first level subsidiary, where the exchange loss is about 126 crores, and that is because of the equity that preference shares that we had put in last year when we had to settle the pensions in the UK of 550 million. So that's the element on the Tata Steel holding, which will continue to have that volatility, as I said earlier. And then there is the overall portfolio in Tata Steel Global Holding, which had about 606 as the impact on the consolidated financial statements.
No, sir, I'm not talking about the impact. I'm talking about the amount on which, maybe suppose if rupee depreciates further or a pound depreciates further, in that amount we will be getting impact. So what is that amount? Is it around 20,000 crore or something less than that?
I can give you the details offline. As I said, the first one is about on 550 million pounds, which is 5,500 crores roughly, or 5,000 crores roughly.
And what is similarly in standalone, sir?
That is a standalone number.
126 crore. Okay. And
no, 1 second. The impact was 126 crore. The underlying asset is about 5,000 crore.
Yeah, I got it. Secondly, sir, this 335 crore differential duty on coal, this is for what period, and is it realized? We have already given, or is it just a provision for that?
No, we have not given. It is actually a bit of an interest on interest issue. It has now got crystallized under the certificate cases under the Bihar Recoveries Act. And therefore we are in appeal as far as this case is concerned. We will take a call as based on how it progresses. But it belongs to a multiple period, almost like last 8-10 years.
Okay. Fair enough, sir. Thanks a lot.
Thank you. We will take the last question from the line of Bhavin Chheda from Enam Holdings. Please go ahead.
Good evening, sir. Congrats on a good set of numbers. Sir, just an industry level question. The recent currency crisis and this Turkish lira has depreciated sharply. Do you see any impact in European market on this? And second is, what's your view on China winter cuts? Because we read a lot, and if we see the dollar strength impacting all the commodity prices, and LME is falling, but the steel has shown tremendous strength. I think part of it is because of the China winter cuts and what would happen in China. So what's your view on these two issues? One impacting Europe and obviously China impacts globally.
So, yes, the Turkish lira is something interesting to watch because Turkey has multiple impacts on the steel business. One is it's a big importer of scrap. So, depreciated lira means Turkey is likely to import less scrap, which can help depress scrap prices, which is good for our Southeast Asian operation because the scrap prices overall then starts balancing downwards and the spread improves. Weaker Turkish lira also means potential for exports to Europe, but the European Union also, I'm sure, is watchful, and there are some safeguards which they've already put in place to make sure that the imports don't go out of hand because this was taken as a precaution against the U.S. action. So we are watching what's happening, and I think what is immediately of concern for the Turkish steel industry is what happens to their exports to the U.S. because there are a lot of cargoes either on the way or ready to go, and many of the Turkish companies will struggle financially, steel companies. I think there's also a concern about the foreign borrowings because I think many of the Turkish companies are borrowed overseas. So there are multiple things happening there. So we will watch it. I think there's no impact, no immediate impact, but we will watch things as they develop. So that is one thing on Turkey. As far as China is concerned, yes, like I said, the China story has not been as bad as we had thought 2 years back, right? Both on the demand side, things have been better than we thought. In fact, even if you look at this year, it's been strong. And it's strong because, not because fixed investments have gone up, but fundamentally across sectors, consumption has been reasonably good. And more importantly, on the supply side, they have taken some actions over the last 2-3 years, which has started, showing up. So, the sector is becoming more organized, sector is becoming more consolidated, and also the actions that the Chinese government has taken on environmental regulation is also adding to the costs of production for most of the Chinese players, particularly the smaller guys who are the disruptors. The bigger guys have always been quite disciplined, and we've never been concerned about unfair competition from a Bao Steel or a Hebei Steel and some of the bigger guys. It's more the smaller guys who used to disrupt the markets, and we are seeing that problem is getting less and less. China, even though they have cut a lot of capacity in the last 2 years, have further announced tightening of environment norms and emissions. So they will continue to squeeze inefficient and polluting capacity over the next 2-3 years. And what he's saying about winter cuts is normal in China, happens every year because that's when the overhang of the pollution is even higher. So normally they would take action, and we expect them to take some action this year as well. That's why if you see the futures prices in China, it's still quite strong. And China is no longer, even if you look at markets like Southeast Asia, it's no longer China who is pulling down the prices. In fact, China is typically higher than most of the other options, including India. So I think overall we see far more stability out of China, than we had seen in the past. And that's why I think it's reflected, as you said, in more stability in steel prices than there is in some of the other commodities. The other point I want to make is all other steel-consuming regions in the world, major steel-consuming regions, are also showing positive growth after 3-4 years. Whether it's the U.S., whether it's Latin America, whether it's Europe, all are doing quite okay. And with the oil prices where they are, the Middle Eastern region is also starting to spend a bit more than they did in the last few years. So there again, the demand is expected to pick up. So that's why the macroeconomic factors are favoring the steel industry, which is, I think, reflected in the prices, as you said.
Thank you, sir, and best of luck.
Thank you very much. That was the last question. I now hand the conference over to Ms. Samita Shah for closing comments.
Yeah, thank you, everyone, on behalf of Tata Steel for joining this call today. I hope we were able to provide you some clarity on not just our performance for this quarter, but also on strategic matters. Thank you once again, and good night.